Trump having won effectively the trifecta, on track to win the House as well, the fact that Eurodollar was still sitting at 108 48 hours after the election didn't make a ton of sense. Now here we are, 105, as you mentioned earlier, 104 handle. We've gone further towards pricing in a more aggressive version of Trump. But as he's shown with some of his policy picks, this is not going to be a conventional administration. And so for me, there is still room for this to run a bit more.
Elsa, I can't find a single person that likes Europe or the euro. I mean, I like Europe, we all like Europe, but likes the European economy or the economy's currency. I'm looking at spreads, 2-year. The differential between Europe and the United States, that's gapped wider to 220. That's the spread between the front end of the German curve and the front end of the US curve. Back in September, that was as low as 135. So rates have done a lot of work already, Elsa. Do you think it's sufficient to sit here and say we've priced in a lot of the rate divergence, maybe it's time to get along the other side of the trade?
So funnily enough, I was asked that same question a week ago, and back then I was definitely no way. Today, it's a little bit more two-way, but here's why I still think it has a bit more room to run. We've heard a lot of people talking about the German election and the room that creates perhaps for some fiscal stimulus. I do think you'll get some slightly easier fiscal policy out of Germany, but it's not going to be the bazooka, the game changer that leads to a real re-rating of European growth expectations. What we're talking about here in terms of tariffs, I don't even think Trump's necessarily going to go after as aggressively go after Europe. But if he goes after China, we're talking about diversion of trade. Europe is going to be competing with China for that rest of world export market. And we know that a lot of Europe's growth in the last few years has been driven by exports, not by domestic consumption. So until that changes, until we see signs of that changing, I don't see this as having kind of run its course.
Also, which is the bigger loser here? Is it Europe and the euro, or is it Mexico and the peso?
But I think part of the reason people are positioning in the euro and a little bit more cautious with the Mexican peso is this is a trade that it's hard to time, right? Trump doesn't take office until January. A lot of the initial policy moves may take 2 or 3 months to fully play out. And so Mexican peso is kind of a difficult currency to sit in there and wait for it all to play out, paying the negative carry. With Europe, you don't really have that problem. Another one we haven't really talked about, the Korean won. You know, you have the intervention there, or the kind of perception that the central bank is really sitting on dollar Korea so that it doesn't move materially higher. But again, you don't have the negative carry working against you. And I think that is what investors are looking for at the moment, these positive carry trades that also benefit from potential escalation in trade war.
How do you disaggregate at the moment, especially when it comes to the dollar? How much of that is about Trump, is about preparing for tariffs? And it's just been the strong data we've seen, Elsa, has been the robust growth that we continue to enjoy in the U.S.
Right. And for me, that's why I said a lot of that move from 112 to 108 was really much more about the data than pricing in anything specific to Trump. When I really think in the first few days after the election, a lot of investors I spoke to were either saying this makes no sense, or were saying he's not going to be a CEO, a kind of active interventionist. He's going to be more chairman. You know, as I think John said earlier, he's regulated by the Dow Jones. You know, if he pursues policies that aggressively weaken the equity market, then he'll stop and pause for thought. But the reality is there's actually quite a lot he can do that's quite damaging to other countries without damaging the US itself. If anything, helping the US, even helping in certain cases equities, particularly the small caps you mentioned earlier. And so for me, when you look at where we stand at the moment, a lot of what we saw through October was about the US data, the strength of the US data, even early November. It's only really now that we're starting to price in those more extreme Trump policies potentially.
Elsa, I'd love to get your thoughts on the yen as well. This morning we're at $156 yen. Do you expect some verbal intervention coming out of Tokyo?
Yeah, absolutely. And I think we've seen a little bit of that already with the comments from Kanda earlier on in the week. The yen is an interesting one, I think, because it was the biggest loser last year, the year before, when we were seeing the real repricing of US rates. For me now, I'm actually a little bit more cautious. And you know, we've been yen bears for a very, very long time. That's not to say that I don't see dollar yen going up. I do. It's just not the most obvious way to express the dollar strength for me in that kind of trade war world, not least in part because if I look at the yields that Japanese investors are running on their overseas stock of assets, it has actually been creeping up over time. So unless you get the Fed actually back to hiking rates, then dollar yen is not the runaway trade to the top side that it was in years previous.
Well, then what's your favorite in terms of the top three to express that dollar strength?
So I do think dollar Korea has that real room to the top side. We've not really seen it yet. Euro dollar for me has a bit more room to run to the downside. Actually, for yen, I'd almost be taking the other side of that trade, not against the dollar, absolutely not. But Swiss yen is one we've been watching for a while. We dipped our toe into it. It didn't work initially, but it now appears to be breaking lower, breaking that rising up trend. And so that's one I've got my eye on.
Elsa, always appreciate your time. Thanks for this morning. Elsa Linios of RBC, following a new low for the euro in the past 15 minutes or so on euro dollar, breaking down to a 104 handle. Moments ago, numbers from Disney, a beat on the top and bottom line, and the outlook, a 3-year outlook. Take a listen to this. Disney projecting high single-digit growth in earnings for fiscal 25, double-digit profit increases in 26 and 2027. That stock is falling just a touch. We'll get some more detail for you in just a moment. We're down about 3.6% in the pre-market. With an update on stories elsewhere this morning with your Bloomberg brief, here's Yahara Hackett. Say Yahara.
Hi, John. Shares fell in Taiwan for key iPhone assembler Han Hai. The reaction coming despite the company, also known as Foxconn, reporting stronger than expected quarterly profit, boosted, of course, by high demand for its servers, powering our artificial intelligence. Putting a number on it, Han Hai expects AI server sales to make up 50% of its total server business in 2025. But it did caution that its smart consumer products business will show a decline this year.